wake up to an email. Not spam, not a promo, your bank. Subject line, important update regarding your home equity line. You're still in bed. You tap it. 7 words. We are suspending your available credit immediately. $73,000. Your safety net just gone. Not stolen, not defaulted, frozen. You call the 800 number at 7:04 a.m. 16-minute hold, smooth jazz. The rep finally picks up. Sounds bored. Per section 12.4 of your agreement, we reserve the right to suspend or reduce. You signed that agreement. You just never made it to page 47. Nobody does. By the time you finish this video, you'll never look at your home equity line the same way. You think that credit line is your money. Emergency fund sitting there, medical bills, tuition, roof replacement. It's not. It's their option to lend, and they can revoke it whenever their risk model gets nervous. Between 2022 and 2024, over 48,000 American homeowners had their equity lines frozen. Not because they missed payments, not because they defaulted. Frozen because the bank's algorithm predicted their house might lose value, or because some risk committee in Charlotte had a bad quarterly forecast. Your emergency doesn't show up in their spreadsheet. I've read 12 different HELOC contracts from major banks. I've spoken with 3 former credit risk officers who executed these freezes. I've obtained internal bank memos marked management eyes only. Here's what you're about to learn. First, the exact contract clause that gives banks unilateral power and why your signature is meaningless. Second, how they decide whose credit to freeze, the algorithm they'll never admit exists. Third, the dark reason this is accelerating right now and why you're next. You think home equity lending works like a mortgage, fixed terms, regulated, consumer protections. You think once they approve your credit line, they can't just take it back. That's adorable. Jennifer Caldwell thought the same thing. Sacramento, February 2023. She opens a HELOC in 2019, $120,000 limit, uses $18,000 for a kitchen remodel. The rest, safety net. Her father's stage 3 cancer wasn't going to pay for itself. Valentine's Day 2023. Jennifer checks her account. Available credit? 0. No missed payment, no collections notice, just an email sent at 6:47 a.m. while she was asleep. She calls, gets transferred 3 times. Finally, someone reads from a script. Ma'am, per your contractual agreement, section 12.4, we retain the right to suspend credit if property values decline or are expected to decline. She pulls out the contract, 52 pages. Page 47, there it is. Lender may reduce or suspend your credit line if the value of your dwelling declines or is expected to decline. Expected, not has declined, expected. They don't need an appraisal, they need a hunch. Here's how the trap works. You don't borrow from a HELOC all at once. You open a line, you draw when you need it. But here's the trick. That available credit isn't a guarantee, it's a revocable privilege. The bank can change the terms, mid-game, mid-emergency, mid-life. Let's follow $1. You apply for a $100,000 HELOC. The bank approves it. Congrats. But here's what they don't tell you. They haven't lent you $100,000. They've granted you access to a credit facility. That facility sits on their books as potential liability, not actual debt, potential. Now, incentive architecture. Banks make money when you borrow, but they lose money when risk spikes and credit is sitting unused. So their models run constantly. Housing values, unemployment rates, recession signals. When risk increases, the algorithm identifies high exposure accounts, accounts with big unused credit lines, like yours. Here's the dark part. It's cheaper for them to freeze your line than to manage the risk. You lose your safety net. They protect their quarterly earnings call. Layer 3, the legal moat. Every HELOC contract has the same escape hatch. Different words, same poison. Lender reserves the right to suspend credit if property value declines, borrower's financial condition changes, or lender deems action necessary to protect security interest. That last one is the nuclear option. Lender deems, not proves, not verifies, deems. No independent appraisal required, no appeal process, just belief. Meet Marcus Holt, Senior Credit Risk Analyst, Top 5 U.S. Bank, 2018 to 2023. His job? Executing HELOC freezes. Every quarter, the risk committee meets. They review forecasts, stress tests. If the models show even a 5% chance of home value decline in a region, we trigger account reviews. My team gets a list: high unused credit, high loan to value, zip codes flagged for downturn. We don't call the customers. We don't warn them. We send the suspension notice. Update the system. Done. Marcus processed 4,000 freezes in 2022 alone. He quit in April 2023. Couldn't sleep anymore. If this pisses you off, do something. Send this video to one person who has an HELOC. Not for me, for the 48,000 families who woke up to frozen credit and nobody to explain why. Drop a comment if you've been hit by this. Let's build a record they can't ignore. Now back to the nightmare. David and Susan Moreno, Phoenix, married 32 years, both retired teachers. They opened an HELOC in 2020, 90,000 approved. Used 12 for a new roof. The rest, emergency fund. Susan's mom needs in-home care. March 2023. Their line freezes. No warning, no phone call. 2 weeks later, Susan's mother falls. Hip fracture, surgery. $28,000 out of pocket. The Morenos don't have it, so they drain their IRA. Early withdrawal penalties, taxes. They lose $41,000 to access $28,000. Susan emails the bank 12 times. Automated responses. David calls every day for 3 weeks. Gets transferred, gets hold music, gets nothing. The algorithm doesn't care about Susan's mother. Marcus remembers accounts like theirs. We knew some of these people would face emergencies. We knew some would be destroyed financially. But the model said freeze, so we froze. I raised it once with my manager. He said, "Our job is risk mitigation, not social work." Marcus lasted 8 more months, then walked. The aggregate scale is staggering. 48,000 accounts frozen. Average unused credit per account, $62,000. Total credit suspended, $2.97 billion. That's not loans forgiven. That's emergency funds deleted, safety nets burned, and every single freeze, perfectly legal. Here's the twist. Your HELOC isn't a loan. It's a call option you sold to the bank. You gave them the right, not the obligation, to lend you money. They keep that right as long as it's profitable and safe. The second it's not, they revoke it. You think you're the customer. You're the counterparty. The dark lesson? Any contract where the other side has unilateral discretion isn't a safety net. It's a liability dressed as an asset. Banks aren't evil. They're rational. When their risk increases, they protect themselves. Your daughter's tuition doesn't override their fiduciary duty to shareholders. Your father's cancer doesn't show up in their Monte Carlo simulation. That's not cruelty. That's just math. And math doesn't return your calls. So what do? What to avoid? Any HELOC with language like expected decline or lender believes or deemed necessary. If the bank has unilateral discretion, you have unilateral risk. What to question? Ask yourself, is this money actually mine or just available until the bank gets nervous? What can they change without asking me? What to understand? An HELOC is not liquid savings, it's contingent credit, and the contingency is their comfort level. What to do? Build boring, unglamorous cash reserves the bank can't touch. High-yield savings, money markets, liquid, boring, yours. If you use an HELOC, draw what you need up front. Convert it to a fixed home equity loan if you can, because once it's borrowed, they can't take it back, only what you haven't used yet. And for God's sake, read page 47 every time. Here's the question you should sit with tonight. How many other contracts have you signed with a Section 12.4 buried inside? How many other safety nets are one algorithm update away from disappearing? Jennifer Caldwell still checks her email at 6:47 a.m. every morning, waiting for the next notice she can't stop. If you want to see the next trap before you step in it, subscribe now. Next video drops in 3 days. Your credit card company can cut your limit mid-swipe. The Supreme Court said it's legal. This is dark finance. We read the fine print so you don't have to. But you still should.